January is expected to be a very good month, probably the best in 10 years after, obviously, a very, very poor 2022. Very good for equities and for bonds at the same time. But we must look at important factors. It's very relevant that gold is performing as well as it is because the market is starting to realize that it's important to have decorrelated assets because equities and bonds go up in unison based on expectations of what central banks are going to do. Second, the IMF has already warned that there might be a very weak economy in 2023 with 1/3 of the global economy in some form of recession, and that must be monitored. It's also important to know that central banks are not going to stop the tightening because of relatively benign inflation figures, because inflation is coming down a little bit, but it's still very elevated, particularly core inflation, and we cannot think that central banks are going to change their policy. The other element is earnings. Earnings estimates continue to be significantly more optimistic than one would expect in such a macroeconomic environment and in such an inflationary environment. So we must pay attention to downgrades. In general, opportunities are arising, but they're not widespread. We need to be very aware of the fact that revisions on the macro front, that elevated inflation and obviously normalization of policy from central banks is going to continue, and that we are going to see a quite weak environment for economic growth. So all in all, an environment that calls for prudence, but certainly in where we can find some opportunities, staying away from the more cyclical part of the investment asset class. Because what we are seeing right now is a lot of opportunities to reduce exposure to the more cyclical assets.